Before we begin, it's critical to understand that the information in this video is for educational and informational purposes only. I am not an attorney, a CPA, or a financial advisor, and this presentation does not constitute legal, tax, or financial advice. The world of corporate structures is complex and varies by state and individual circumstance. Always consult with a qualified professional team before making any decisions about your business or investments. Imagine you own a successful pizza shop. It's your pride and joy. You've perfected the dough, the sauce is a family secret, and you're making great money. Life is good. You decide to expand. You use the profits from the pizza shop to buy the building next door and open a trendy craft brewery. Then, you buy a small fleet of delivery vans to start a local logistics service. You are now the proud owner of 3 distinct businesses: a pizzeria, a brewery, and a delivery company. You feel like the king of your town. Then the unthinkable happens. One of your delivery drivers while on the job causes a major accident. The lawsuit is massive, far exceeding your insurance coverage. The court issues a judgment against your delivery company for millions of dollars. But here's the devastating part. Because you own all 3 businesses under one single legal entity, or maybe just as a sole proprietor, that lawsuit doesn't just attack the delivery company. It gives the creditors the right to come after the brewery. They can seize your brewing equipment, your inventory. And worse, they can come after your crown jewel, the pizza shop that started it all. They can drain its bank accounts, put a lien on the property, and force its sale. In an instant, one mistake in one part of your empire has burned the entire kingdom to the ground. This isn't a scare tactic. This is the tragic reality for countless entrepreneurs who build something amazing, but build it on a foundation of sand. But what if I told you there was a way to build firewalls between your businesses? A legal structure that allows your pizza shop to thrive, completely untouched, even if the delivery company goes bankrupt? What if I told you this is the exact same fundamental strategy used by Warren Buffett, Google, Disney, and nearly every major corporation and wealthy family in the United States to protect their assets, minimize their taxes, and manage vast, complex empires? This structure is called an investment holding company, and understanding it is not just for billionaires and skyscrapers. It is one of the most powerful tools available to any serious entrepreneur, real estate investor, or anyone looking to build and protect generational wealth. Forgetting this isn't like forgetting to post on social media. This is a foundational architectural mistake that can cost you everything. Over the course of this presentation, we are going to demystify the holding company. We're going to pull back the curtain on the corporate structure of the elite and show you how it works step by step, in plain English. You will learn precisely what a holding company is and what it isn't. You'll understand the critical difference between a holding company and an operating company. We will break down the 3 monumental advantages. First, the ironclad asset protection that creates that firewall we talked about. Second, the significant tax efficiencies and strategic advantages that are simply impossible with other structures. And third, the streamlined management and estate planning benefits that allow wealth to grow and pass from one generation to the next. By the time you're done watching, the term holding company will no longer be some confusing piece of financial jargon. You will see it for what it is: a strategic blueprint for building a resilient, scalable, and protected business empire, whether that empire consists of 2 rental properties or 200 global brands. So let's start with the absolute basics. What on earth is a holding company? The simplest way to think about it is a parent-child relationship. A holding company is the parent corporation, but this parent doesn't make pizza, it doesn't brew beer, and it doesn't deliver packages. In fact, in its purest form, a holding company doesn't do anything. It doesn't have customers. It doesn't have operations. It doesn't sell any products or services. Its only job, its entire reason for existence, is to own things. Specifically, it owns a controlling interest in other companies. Those other companies, the pizza shop, the brewery, the delivery service, are the children. In the corporate world, they're called subsidiaries. These are the operating companies. They are the ones on the front lines doing the actual work. They have the employees, they have the customers, they generate the revenue, and they take on the day-to-day business risks. So the parent holding company owns the subsidiary operating companies. That's the entire structure. Sounds simple, and it is. But this simple separation is the source of its incredible power. The holding company is an empty vessel, a corporate shield whose primary purpose is to hold the ownership, stock, or membership interests of the companies that actually do the work. You see this structure everywhere once you know what to look for. Think about Google. You use Google search, you watch YouTube, you use the Android operating system on your phone. You might think you're a customer of Google, but the massive public company that trades on the stock market isn't actually Google. It's a company called Alphabet, Incorporated. Alphabet is the parent holding company. Its job is to own the other companies. Google LLC, which operates the search engine and ad business, is one of its children, a subsidiary. YouTube LLC is another subsidiary. Waymo, their self-driving car company, is another. Each of these is a separate legal entity, an operating company doing its own thing with its own risks and liabilities. Alphabet, the parent, sits at the top, owning and managing its portfolio of children. Another perfect example is Meta Platforms Incorporated. You know them as Facebook, but Meta is the holding company. It doesn't run your news feed. Its job is to own the companies that do. It owns Facebook, the social media platform. It owns Instagram. It owns WhatsApp. It owns Oculus, the virtual reality company. Each is a separate subsidiary, insulated from the direct liabilities of the others. But the undisputed master of the holding company structure is Warren Buffett's Berkshire Hathaway. When you buy a share of Berkshire Hathaway stock, you aren't buying a company that does one thing. You're buying a piece of a parent holding company that owns a staggering collection of subsidiary companies. Berkshire Hathaway fully owns Geico Insurance, Duracell Batteries, Dairy Queen, See's Candies, BNSF Railway, and dozens of other massive operating companies. It also owns significant, but not controlling, stakes in other public companies like Apple and Coca-Cola. Berkshire Hathaway itself doesn't sell you insurance or make you a chocolate nut cluster. It is the ultimate parent company. Its full-time job is to allocate capital and oversee its vast family of subsidiaries. Geico can face billions in insurance claims from a hurricane, but those claims can't legally touch the assets of Duracell or Dairy Queen. Each child lives in its own legal house, and the parent Berkshire Hathaway owns all the houses. This separation is the key. It's the entire game, and it's the first and most important benefit we need to explore. The fortress of asset protection. Imagine you're building a ship. Not just any ship, but a massive modern-day battleship designed to sail through the treacherous seas of business. You have different sections: the engine room, the cargo hold, the navigation bridge. Now, what's the golden rule of naval architecture? Watertight compartments. If the hull is breached and one compartment floods, you seal the bulkheads. The water is contained. The rest of the ship stays afloat, and you survive to sail another day. Without a holding company, your entire financial life is a single open hull. A breach anywhere, a lawsuit in one business, a debt in another, floods the entire ship. Everything sinks together. Your successful real estate venture gets dragged to the bottom by a failing restaurant. Your stock portfolio gets liquidated to pay for a liability from a side hustle you barely remember starting. The holding company structure is what builds those watertight, steel bulkheads between your assets. Each operating business, each subsidiary is its own compartment. If one floods, you seal the door. The lawsuit, the debt, the liability, it's contained. It cannot spread and sink the rest of your fleet. This isn't just a clever metaphor. It's a legal reality known as limited liability. And the holding company is the ultimate expression of it. Let's make this real. Meet Sarah. Sarah is a brilliant entrepreneur. She owns two businesses. The first is a thriving chain of boutique coffee shops called Morning Buzz, operating as an LLC. It's her pride and joy, profitable and growing. The second is a small experimental tech startup she's personally funding, Innovate Solutions Incorporated. It's her passion project, high risk but with a potentially massive payoff. In a typical setup, Sarah might own both of these directly. Her name is on the ownership documents for both companies. One day, disaster strikes at Morning Buzz. A new espresso machine is installed incorrectly, it malfunctions, and a customer is seriously burned. A lawsuit follows. It's a big one. The lawyers are seeking damages far beyond what the coffee shop's insurance policy covers. So, they go after the assets of Morning Buzz LLC itself, the bank accounts, the equipment, the inventory. But it's not enough to cover the judgment. What happens next? The lawyers look at who owns Morning Buzz. They see Sarah's name. And because she personally owns Innovate Solutions, they can now argue that its assets should be fair game. They could even come after her personal assets, her home, her savings. The single lawsuit, the one leak in her coffee business, is now threatening to sink her entire financial world. Her passion project, her personal security, everything is at risk. Now let's rewind. Let's imagine Sarah was smarter. Before any of this happened, She established Sarah Holdings LLC. This holding company doesn't make coffee or write code. Its only job is to own other companies. So Sarah Holdings LLC owns 100% of Morning Buzz LLC, and it owns 100% of Innovate Solutions Incorporated. Sarah, in turn, owns 100% of Sarah Holdings LLC. Notice the chain of command. Sarah owns the parent owns the children. The children are now siblings, not conjoined twins. The same accident happens. The same lawsuit is filed against Morning Buzz LLC. The court awards the same massive judgment. The lawyers again go after the assets of Morning Buzz LLC. They drain its bank accounts, they seize its equipment. But when they try to cross the bulkhead and go after Innovate Solutions, they hit a legal brick wall. Why? Because Sarah doesn't personally own Morning Buzz anymore. Sarah Holdings LLC does. The lawsuit is against Morning Buzz LLC, a separate legal person. The only owner they can go after is its parent company. And what are the assets of Sarah Holdings? It's not cash. It's not property. Its primary assets are simply the ownership shares of its subsidiaries. So the absolute worst-case scenario is that the holding company might be forced to give up its shares in the failing Morning Buzz. But the key is this: the lawsuit stops there. It is legally contained. Innovate Solutions is a completely separate entity, owned by the same parent, but it is not liable for its siblings' debts or legal troubles. The lawyers can't touch its bank accounts, its intellectual property, or its assets. And most importantly, because Sarah is insulated by her own holding company, they can't touch her personal home, her car, or her savings. This legal shield is called the corporate veil. Think of it as a one-way mirror. You, the owner, can see and control the business through the holding company, but the business's creditors and legal opponents can't see past the veil to get to you or your other assets. The holding company structure creates multiple layered veils. There's a veil between Morning Buzz and Sarah Holdings. There's another veil between Innovate Solutions and Sarah Holdings. And there's a final crucial veil between Sarah Holdings and Sarah herself. It's a fortress with concentric walls of legal protection. Now you might be thinking, can't a clever lawyer just pierce that corporate veil? Yes, they can try. Piercing the corporate veil is a legal maneuver to go after the owners of a company. But it's incredibly difficult to do if the companies are run properly. It typically only succeeds when there's fraud, or when the owner treats the company like a personal piggy bank, a concept called commingling of funds. As long as Sarah keeps separate bank accounts for each business, signs contracts in the name of the correct LLC, and follows the corporate formalities, that veil is as strong as steel. The holding company structure actually makes this easier, forcing a discipline of separation that strengthens the veil for every single entity in the system. This isn't just for small business owners like Sarah. This is exactly how the titans of industry operate. When you hear about a massive product recall for a specific car model from General Motors, the financial fallout is contained within that division. It doesn't automatically bankrupt Chevrolet or Cadillac. When a pharmaceutical company faces $1 billion lawsuit over a single drug, the parent company, with its dozens of other successful drugs, is structured to withstand the blow. This is the defensive power of a holding company. It's financial compartmentalization. It allows you to take risks, to innovate, to run multiple ventures without the fear that a single failure could cause a catastrophic, cascading collapse of everything you've ever built. It transforms your financial life from a fragile house of cards into a resilient modular system. You can lose a battle in one subsidiary and still win the war. This protection provides something more valuable than money: peace of mind. The ability to sleep at night, knowing that a storm hitting one of your ships won't sink your entire fleet. It's the freedom to be ambitious, to be an entrepreneur, to build diverse streams of income, all while resting on a foundation of legal rock. But building a fortress to protect what you have is only half the story. Because this same structure, this elegant separation of entities, does more than just play defense. It unlocks a whole new level of strategic offense. It allows you to manage your assets in a way that is profoundly more efficient. And that efficiency is most powerfully seen when we look at the one entity that can legally take your money without even needing a lawsuit: the IRS. The holding company doesn't just act as a shield against legal threats. It can be transformed into a master key for unlocking immense tax advantages. And that's where things get really interesting. Let's start with a simple, powerful idea: tax deferral. This isn't about tax evasion. This is about tax control. It's about you, the investor, deciding when the government gets its cut, not the other way around. Imagine you own a promising tech startup through your personal brokerage account. After 5 years of hard work, it gets acquired for $1 million. Fantastic! But the moment that cash hits your personal account, the IRS is standing right there, hand outstretched, ready to take its capital gains tax. Let's say 20% or $200,000. Your $1 million win is instantly an $800,000 reality. You're left with less capital to reinvest, and your momentum is cut short. Now rewind. Imagine you owned that same startup, but this time it was held inside your investment holding company. The acquisition happens, the same $1 million is paid out. But instead of going into your personal bank account, it flows directly into the bank account of your holding company. And here's the critical difference. Because the money never left the corporate structure, it hasn't been distributed to you as an individual. In the eyes of the IRS, you haven't personally realized the gain yet, which means that $200,000 tax bill, it hasn't been triggered. Think of your holding company as a financial greenhouse. Inside this greenhouse, you can plant seeds, grow them into valuable assets, and then sell them at harvest time. As long as the money you make from the sale stays inside the greenhouse, you can use 100% of it to buy new seeds, new soil, better equipment, to reinvest and grow your next venture. The tax man is standing outside in the rain waiting. He only gets to come in and take his share when you decide to take money out of the greenhouse for your personal use. You've effectively paused the tax clock, giving your capital the freedom to multiply unburdened. This single concept, tax-deferred compounding, is the closest thing to a superpower in the world of finance. Let's go back to that $1 million sale. Without a holding company, you reinvest $800,000. Let's say you earn a solid 10% annual return. In 10 years, that $800,000 grows to about $2.1 million. Not bad at all. But with the holding company, you reinvest the entire $1 million. At the same 10% return after 10 years, your investment is worth nearly $2.6 million. That's a difference of $500,000. It's ghost money, wealth that was created purely because you controlled the timing of your taxes. You didn't need a riskier investment or a higher return. You just used a smarter structure. You allowed your entire army of dollars to fight for you, instead of sending 20% of them home before the battle even began. But the tax advantages don't stop there. It gets even more intricate. Let's talk about dividends. Many of the businesses or assets a holding company owns will generate income and pay out dividends. If you personally own stock in, say, Coca-Cola, and it pays you a dividend, that income is taxed on your personal return. But when one of your subsidiaries, let's call it operating company, pays a dividend up to its parent, your holding company, a special rule kicks in. It's called the dividends received deduction, or DRD. This is a provision in the U.S. tax code specifically designed to prevent the same money from being taxed over and over again as it moves through a corporate chain. In essence, the government recognizes that the profit was already taxed at the subsidiary level, so it shouldn't be fully taxed again when it's simply transferred to the parent company. Depending on how much of the subsidiary the holding company owns, it can typically deduct anywhere from 50% to 100% of the dividends it receives from its taxable income. So, if your operating company earns a profit and sends a $100,000 dividend up to your holding company might only have to treat $50,000 of it as income, or in some cases none of it at all. This creates a massively efficient way to move capital around your financial empire. You can pull profits from a successful, cash-rich subsidiary and move them up to the holding company, almost tax-free. From there, the holding company can act as a central bank, deciding where to allocate that capital next. It could use that $100,000 to fund a new, high-growth startup you're launching, to pay down debt in another subsidiary, or to simply invest in the public markets, all without triggering a major tax event. It's a closed-loop system, designed for maximum capital efficiency and growth. And this system gives you another powerful tool: strategic consolidation of gains and losses. Let's say you are a brilliant entrepreneur, and you own two separate businesses as a sole proprietor. One is a thriving e-commerce store that just had a banner year, netting a $500,000 profit. The other is a brick-and-mortar retail shop you're trying to get off the ground, which unfortunately posted a $100,000 loss for the year. If these are two totally separate entities, you're in a tough spot. You'll pay income tax on the full $500,000 of profit from the e-commerce store. The $100,000 loss from your retail shop offers you very limited, if any, immediate relief on that massive tax bill. The government celebrates your winner, but offers little sympathy for your loser. Now let's place both of those businesses under the umbrella of a single holding company. The holding company now looks at the combined performance of its assets. It sees a $500,000 gain from one subsidiary and a $100,000 loss from the other. For tax purposes, the holding company can often consolidate these figures. The loss from the struggling retail shop can be used to offset the gains from the booming e-commerce store. So, instead of paying taxes on $500,000 in profit, the holding company pays taxes on the net profit of $400,000. Your struggling venture has just become a valuable asset, acting as a tax shield for your successful one. This portfolio approach to taxation allows you to be more daring. It lets you take risks on new ventures, knowing that even if they fail, the losses can serve a strategic purpose by sheltering the gains from your proven winners. This is what the world's wealthiest investors understand. A holding company isn't just a box to put assets in. It's an active, dynamic financial engine. It's a tool for deferring taxes to maximize compounding, for efficiently moving capital between ventures, and for strategically balancing your wins and your losses. It transforms your tax bill from a mandatory, annual punishment into a strategic variable that you can largely control. But optimizing your taxes year to year is just one piece of the puzzle. The true long-term power of a holding company goes far beyond that. It's about building a structure that can outlive you. It's about crafting a financial legacy, a modern-day dynasty, that protects and grows wealth not just for years, but for generations. And the mechanics of how that works are where the real genius of this structure is revealed. So, what are these mechanics? How does this financial fortress actually stand? It begins with a fundamental shift in thinking. Instead of viewing your assets as a pile of disconnected things, a house here, a stock portfolio there, a small business over here, you start to see them as an interconnected ecosystem, a kingdom that you rule. The investment holding company is the castle at the center of that kingdom. Let's get concrete. Imagine you have a few different ventures. You own 2 rental properties, you have a sizable stock portfolio, and you run a profitable online consulting business. Right now, if you're like most people, these are all tangled up with your personal life. Maybe the properties are in your name, the stocks are in a personal brokerage account, and the business is a sole proprietorship. This is the financial equivalent of building a village on an open plain with no walls. One fire, one lawsuit, one economic storm, and everything can be wiped out. A single lawsuit against your rental property because a tenant slips and falls could potentially jeopardize not just that property, but your stock portfolio, your business, and even your personal home. Everything is exposed. The holding company changes the entire map. The first step is to build the central keep, the command center. This is your holding company. For simplicity, let's call it Apex Holdings LLC. This is a new, separate legal entity that you create. Its purpose isn't to sell widgets or rent apartments. Sole purpose is to own things. Specifically, it's going to own other companies. Now, we build the defensive towers around the keep. For each of your distinct asset classes, you create a separate company, a subsidiary. So, your 2 rental properties, you create Keystone Properties LLC, and transfer the deeds of those properties into this new LLC. Your stock portfolio, you set up Momentum Capital LLC, and open a brokerage account in that company's name, funding it with your investment assets. Your online consulting business, that becomes Digital Strategies LLC. Here is the most critical piece of the puzzle, the linchpin of the entire structure. Who owns these new LLCs? You don't. Apex Holdings LLC, your holding company, owns them. You own and control Apex Holdings. So the chain of command is clear. You control the holding company, and the holding company in turn owns and controls all the operating subsidiaries. You've just engineered a system of watertight compartments. Think of it like a modern submarine. If one section floods, bulkheads slam shut, and the rest of the vessel remains secure and operational, a lawsuit can no longer start a wildfire that burns down your entire financial life. Let's replay that slip and fall scenario. The tenant sues. But who do they sue? They sue the owner of the property, which is Keystone Properties LLC. The lawsuit is contained entirely within that single tower of your kingdom. The plaintiff's lawyers can only go after the assets held inside Keystone Properties. In this case, the 2 rental units. They cannot touch the assets inside Momentum Capital. They cannot touch the revenue from Digital Strategies. And most importantly, they cannot breach the walls of the central keep, Apex Holdings, and they certainly cannot get to your personal assets. The corporate veil, as it's legally known, acts as an impenetrable legal shield between each of your ventures. This isn't some shady loophole. It's a foundational principle of corporate law. designed specifically for this purpose, to encourage investment and entrepreneurship by limiting risk. But this structure is about so much more than just defense. It's an engine for offense for strategic growth. Let's talk about cash flow. Each of your subsidiaries is generating income. Keystone Properties collects rent. Digital Strategies earns consulting fees. Momentum Capital generates dividends and capital gains. After each company pays its own specific expenses, property maintenance for Keystone, software subscriptions for Digital, the profits don't just sit there. They are formally distributed up to the parent company, Apex Holdings. Suddenly, Apex Holdings becomes a central bank, a private treasury for your entire enterprise. All the streams of income from your disparate businesses now flow into one central reservoir of capital. This is where the real power of a CEO, the real power of a dynasty builder, comes into play. You, as the manager of Apex Holdings, now get to decide how to allocate that capital with maximum strategic impact. Is the real estate market booming? You can direct Apex Holdings to loan capital down to Keystone Properties to acquire a third rental unit, without Keystone having to go to a bank for a loan. You become your own lender, funding the growth of your most promising ventures from the profits of your other ventures. Did your consulting business just have a record-breaking quarter? That cash flows up to Apex, and maybe you decide the stock market is undervalued. You can then direct Apex to inject that capital into Momentum Capital to buy up stocks at a discount. You're using profits from one area to seize opportunities in a completely different one. You can also use this central pool of capital to launch entirely new ventures. Maybe you want to start an e-commerce brand. Instead of funding it from your personal bank account, you establish a new subsidiary, say, Direct Commerce LLC, owned by Apex Holdings, and Apex provides the startup capital. The new venture is instantly integrated into your fortress, protected and funded by the strength of the whole, yet segregated so that if it fails, it doesn't drag anything else down with it. This centralized capital allocation is how figures like Warren Buffett operate Berkshire Hathaway. Berkshire Hathaway itself doesn't make insurance policies or railroad cars or ice cream. It is a holding company. It owns companies that do Geico, BNSF Railway, Dairy Queen. The profits from all those disparate businesses flow up to the parent company in Omaha, and Buffett and his team then decide where to reinvest that massive pool of capital for maximum return. You are replicating that exact same professional, powerful structure on your own personal scale. Simplifies everything. Instead of managing 3 or 4 or 10 different chaotic ventures, you are managing one clean, organized system. Your accounting is streamlined. Your legal strategy is unified. And when the time comes to think about legacy, the transition is breathtakingly simple. You don't have to pass down a messy collection of deeds, account numbers, and business assets. You only have to pass down one thing: ownership of Apex Holdings, LLC. The operating businesses, the subsidiaries, continue to run without interruption. The tenants keep paying rent, the clients keep paying for consulting. The machine doesn't stop. The transfer of power can be as simple as updating the ownership documents of a single company. You can place your shares of the holding company into a trust for your children, ensuring that the economic engine you built continues to run, providing for them, their children, and their children's children. You've transformed a collection of jobs and assets into a perpetual system. We've built the fortress and established the flow of gold. But there's another hidden layer of power in this design, a way to legally and ethically minimize the one thing that can erode any dynasty: taxes. And the strategies the ultra-wealthy use to do this, all perfectly legal within the holding company structure, are both simpler and more brilliant than you can imagine. So what is this grand legal architecture for tax avoidance? It isn't some shady offshore scheme. It's a series of interconnected strategies, all built upon the foundation of the holding company itself. The first, and perhaps most powerful, is a concept called the dividends received deduction, or DRD. Now, stick with me because this one concept is the key that unlocks so much of the holding company's financial power. Imagine you own a successful plumbing business, organized as a C corporation. It makes $1 million in profit. The corporation pays its corporate income tax on that $1 million, let's say 21%, so it pays $210,000 to the IRS. Now you have $790,000 left. You, the owner, want to take that money out as a dividend to buy a house. The moment that money hits your personal bank account, boom, it gets taxed again as personal income at your dividend tax rate. This is the classic problem of double taxation that plagues so many business owners. The government gets a slice when the business earns it, and another slice when you personally receive it.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
But now, let's slot a holding company on top. The plumbing business still makes $1 million, still pays its $210,000 in corporate tax. But instead of paying the remaining $790,000 dividend to you, it pays it up to its parent, your holding company. Now here's the magic. Because of the dividends received deduction, the holding company doesn't have to pay tax on most of that dividend income. Depending on the ownership percentage, typically 50% to 65% of those dividends are completely exempt from federal income tax. In many cases, if the holding company owns over 80% of the subsidiary, 100% of that dividend is tax-free. Think about what just happened. $790,000 just moved from the operating company, where it was at risk, into the safe, fortified vault of the holding company, and it did so almost entirely tax-free. It's like a financial teleportation device. The money is now safe, consolidated, and ready to be deployed somewhere else, to buy another business, to invest in stocks, to purchase real estate, all without suffering that second brutal layer of tax. The money stays within the corporate ecosystem, growing and compounding, shielded from personal taxation until the day you, the ultimate owner, decide to pay yourself. This single mechanism is how family empires are built. They don't drain their companies of cash every year. They flow the profits upward into the holding company, creating a massive, ever-growing war chest of capital. The second strategy is the art of deferring capital gains. Let's say your plumbing business is now worth $10 million, and you only put $100,000 in to start it. If you sell that business, you have a massive capital gain of $9.9 million. That's going to trigger a tax bill that could easily be over $2 million. A huge chunk of your life's work gone in an instant. The holding company offers a different path. Instead of selling the plumbing business for cash, the holding company can engage in strategic swaps and reorganizations. For instance, it could sell the subsidiary not for cash, but in exchange for stock in the acquiring company. Through various sections of the tax code, like the famous Section 351 exchange, this can often be structured as a tax-free reorganization. You haven't received cash, so you haven't had a taxable event. You've simply swapped one asset, the plumbing company, for another asset, stock in a different company. The tax on that $9.9 million gain isn't eliminated, but it's been deferred. You've kicked the can down the road. Now your holding company, which once held a plumbing business, now holds a $10 million block of stock in a larger corporation. You can continue to do this, swapping assets for other assets, rolling your gains from one investment into the next, all while the tax liability remains a distant problem for a future date. The ultra-wealthy can do this for decades, allowing their entire untaxed capital gain to continue working for them, compounding year after year. It's the difference between investing with your full dollar or investing with the 75 cents you have left after the government takes its cut. Over a lifetime, that difference is monumental. Third, the holding company acts as a strategic cost center. Imagine the family dynasty owns 5 different operating businesses: the plumbing company, a small manufacturing plant, a chain of local coffee shops, a software startup, and a portfolio of commercial real estate. Each one of these needs high-level management, legal advice, accounting services, and strategic direction. Instead of each company hiring its own expensive CEO, CFO, and legal team, the holding company does it. The holding company becomes the central brain. It hires the best, most expensive talent. It leases the prestigious headquarters. It pays for the top-tier accountants and lawyers. Then, it charges each of its subsidiary operating companies a management fee for these shared services. From the perspective of the profitable coffee shop or plumbing business, this management fee is a perfectly legitimate, tax-deductible business expense. It reduces their taxable income, lowering the amount of money they send to the IRS. Meanwhile, at the holding company level, that fee income it just received is used to pay for all those expensive salaries and overhead costs. The income is offset by the expenses. The result is a system of perfect efficiency. You concentrate your major expenses in one central entity and use them to systematically reduce the taxable profits across your entire portfolio of businesses. It's an elegant way to ensure that every possible dollar of overhead is put to work, not just running the business, but legally minimizing its tax burden. Finally, and this brings us back to the idea of a dynasty, the holding company is the ultimate tool for estate planning. The goal of the ultra-wealthy is to pass their fortune to the next generation without giving half of it to the government in the form of estate taxes, which can be as high as 40%. Trying to give your children pieces of 5 different businesses is an accounting nightmare. You'd need 5 different valuations, complex legal transfers for each one. It's messy and expensive, but with a holding company, you don't own 5 businesses. You own one thing, shares of your holding company, and transferring those shares is simple. Every year, you can gift shares of your holding company to your children or grandchildren, up to the annual gift tax exclusion amount, which is currently over $17,000 per person. A married couple could give over $34,000 worth of shares to each of their kids' spouses, and their grandkids year after year completely tax-free. Over a decade or two, you can transfer a significant percentage of the entire family enterprise to the next generation without ever writing a single check for gift or estate taxes. You are methodically passing the torch piece by piece, share by share. The holding company structure makes the wealth divisible and transferable in a way that direct ownership of assets could never be. It allows for a slow, controlled, and incredibly tax-efficient transition of power and wealth, ensuring the dynasty doesn't just survive, but thrives into the next generation. These strategies, the DRD, capital gains deferral, expense allocation, and estate planning, are not loopholes. They are fundamental, intended features of the U.S. tax code, designed to encourage investment and capital formation. And the holding company is the vehicle perfectly engineered to take advantage of every single one of them. So let's get into the mechanics. The architecture. What makes this structure so powerful? It comes down to 3 core pillars of strength, 3 foundational advantages that separate a sophisticated financial operation from a simple collection of assets. These pillars are: first, the tax-efficient movement of capital; second, the compartmentalization of liability; and third, the streamlined transfer of wealth. Let's start with the first and arguably most powerful pillar, the movement of capital. This is the engine of the entire system. Imagine you own 2 separate successful businesses. Let's say one is a thriving software company, Innovate Corp., and the other is a growing chain of coffee shops, Morning Grind LLC. Innovate Corp has a fantastic year and generates $1 million in profit. You want to use that profit to expand Morning Grind, to open 3 new locations. This is a classic business scenario, using the cash from a mature, profitable venture to fuel the growth of another. Now, if you own both of these as separate entities directly in your own name, here's what happens. First, Innovate Corp. as a C corporation pays its corporate income tax on that $1 million. Let's say that's 21%, so $210,000 goes to the IRS. That leaves $790,000. Now, to get that money out of Innovate Corp. and into your hands so you can invest it in Morning Grind, Innovate Corp. has to issue you a dividend. That $790,000 dividend hits your personal bank account, and guess what? It's a taxable event. For you, personally, you'll pay a dividend tax which could be up to 20%, plus potentially a net investment income tax of 3.8%. So let's call it 23.8%. That's another $188,020 in taxes. So, from your original $1 million of profit after 2 layers of taxation, you are left with just over $600,000 to actually invest in your coffee shop expansion. Nearly 40% of your profit was vaporized by taxes before it could even be put to work. It's like trying to carry water in a leaky bucket. Every step you take, you lose more of what you need most: capital. This is the problem of double taxation. And it is the single biggest enemy of efficient capital allocation for entrepreneurs and investors. You earned the money in the corporation, it was taxed. You moved the money to yourself, the owner, and it was taxed again. Now let's rewind and run the exact same scenario, but this time with a holding company. We'll call it Apex Holdings. You don't own Innovate Corp. and Morning Grind directly anymore. Instead, Apex Holdings owns 100% of both companies. They are now wholly owned subsidiaries. You in turn own Apex Holdings. Innovate Corp. has the same fantastic year. It earns $1 million in profit. It still pays its corporate income tax of $210,000. That part doesn't change. It still has $790,000 in after-tax profit. But here is where the entire game changes. Innovate Corp. needs to get that money to its parent company, Apex Holdings, so it can be deployed to its sister company, Morning Grind. Does this by paying a dividend, But this isn't a dividend to you personally. It's a dividend from one corporation, the subsidiary, to another corporation, the holding company. And this is where a magical section of the Internal Revenue Code kicks in. It's called the Dividends Received Deduction, or the DRD. The DRD is a rule that says when a corporation receives a dividend from another corporation that it owns stock in, a significant portion of that dividend is not subject to tax. It's essentially a tax deduction for the dividend income received. The government recognizes that taxing this same dollar again as it moves between a parent and a subsidiary would be triple, or even quadruple taxation, and would completely paralyze capital flow within the economy. So how much of the dividend is deductible? It depends on the percentage of ownership. If the holding company owns less than 20% of the subsidiary, it can deduct 50% of the dividend. If it owns between 20 and 80%, it can deduct 65%. But here's the key, the holy grail for this structure. If the holding company owns 80% or more of the subsidiary, which in our case it owns 100%, it can deduct 100% of the dividend. Let that sink in. Innovate Corp pays the $790,000 dividend up to Apex Holdings. Apex Holdings receives the $790,000. And because of the 100% dividends received deduction, the taxable income for Apex Holdings on that transaction is zero. A big beautiful zero. The entire $790,000 moves from the software company to the holding company completely intact. No tax leakage. The leaky bucket has been sealed. Now Apex Holdings, sitting with that $790,000 in cash, can immediately turn around and contribute that capital down to its other subsidiary, Morning Grind LLC, to fund the expansion. The money has moved from the entity that generated it to the entity that needs it for growth, without ever touching your personal tax return and triggering that second devastating layer of tax. Compare the two scenarios. Without the holding company, you have about $600,000 to invest. With the holding company, you have $790,000. That is a 31% increase in available growth capital. Instantly. What could you do with 31% more capital every single year? You could open 4 new coffee shops instead of 3. You could hire more developers. You could acquire a competitor. This isn't a minor accounting trick. It is a fundamental strategic advantage that allows your capital to compound at a dramatically faster rate. This tax-free or tax-reduced movement of capital is the circulatory system of a sophisticated investment empire. It allows you to be nimble. It allows you to reallocate resources from your cash cows to your rising stars seamlessly. You can harvest profits from a stable real estate portfolio and inject them into a high-growth tech startup you own, all within the protective, tax-efficient walls of the holding company structure. Think of it like a financial command center. You, as the owner of the holding company, can view your entire portfolio of businesses from a 30,000-foot view. You see which ones are generating excess cash and which ones are hungry for it. And with the DRD, you have the power to direct those financial resources with maximum efficiency, like a master chess player moving pieces around the board, all without paying a tax toll every time you make a move. This is how wealth is not just built but strategically multiplied. It's the difference between building with bricks and building with Legos. One is slow and permanent, the other is modular, flexible, and allows you to rebuild and reconfigure your structure as new opportunities arise. But this powerful engine for moving capital is only one part of the equation. It's the offense. It's how you grow. But what about defense? What happens when something goes horribly wrong in one of your businesses? What about protecting the rest of your empire from the fallout? That brings us to the second pillar of holding company strength, the liability fortress. Now, imagine your business empire is a medieval castle. The holding company is your central keep, the strongest, most fortified part of the structure. Each of your operating businesses, your subsidiaries, is a separate tower built along the castle wall. Each tower has its own defenses, its own resources, and its own purpose. The concept of the liability fortress is simple. If one tower is attacked and breached, the attackers are contained within that tower. They can't just run across the courtyard and into your central keep or into the other towers. The walls are too high. The gates are sealed. This separation is the entire point. In the business world, the attackers are lawsuits, creditors, and catastrophic financial failures. And the walls are what lawyers call the corporate veil. Let's make this real. Meet 2 versions of an entrepreneur named Alex. In Universe A, Alex is a brilliant operator. He starts a successful chain of high-end gyms called FitLife. They're profitable, growing, and have a great reputation. Flush with success, Alex decides to diversify. He sees a huge opportunity in the high-risk, high-reward world of commercial real estate development. He starts a new division under the same FitLife Incorporated corporate umbrella to buy land and build a luxury condo complex. He uses the profits and the assets from the gym business to secure the loans for the construction project. It's all one big company, one big balance sheet, one big pot of money. Then disaster strikes. A construction crane at the condo site collapses. It's a tragic accident with multiple injuries and massive property damage. The lawsuits start flying in, and they are astronomical, far exceeding the project's insurance coverage. The lawyers for the plaintiffs don't just sue the real estate division. They sue the entire company, FitLife Inc. And because it's all one legal entity, they have the right to go after everything. The court doesn't see a gym business and a real estate business. Sees one company with assets. Suddenly, the bank accounts for the gyms are frozen. The gym properties themselves get liens placed on them. The profitable, stable, healthy business that Alex spent a decade building is now being torn apart to pay for the catastrophic failure of a completely separate venture. The walls of one tower were breached, and the entire castle is now being ransacked. Alex loses everything. Now let's rewind. Let's visit Alex in Universe B. This Alex is just as brilliant, but he's also strategic. When he decides to get into real estate, his lawyer advises him to structure things differently. He forms Alex Holdings LLC. This holding company does nothing but own other companies. Underneath it, he has FitLife LLC, which owns and operates the gyms. Then he creates a completely separate, new subsidiary called Apex Development LLC to handle the condo project. Alex Holdings owns 100% of FitLife LLC and 100% of Apex Development LLC. The same tragic crane accident happens. The same massive lawsuits are filed. But this time, who do they sue? They sue Apex Development LLC, and they can only go after the assets held inside Apex Development LLC. That might be the land for the project, the construction equipment, whatever cash is in its specific bank account. But they can't touch FitLife LLC. They can't freeze the gym's bank accounts. They can't put a lien on the gym's properties. They can't even touch the cash sitting inside Alex Holdings. Why? Because FitLife and Alex Holdings are separate legal persons. The corporate veil between them is strong. Apex Development might go bankrupt. It might be a total loss. But that one tower crumbles while the rest of the castle, the profitable gym business and the central keep, remains completely untouched and secure. Alex lives to fight another day. His core wealth-generating asset intact. This is not some tax loophole. This is a foundational principle of corporate law in the United States. It's called limited liability, and a holding company structure is the ultimate expression of it. Each subsidiary is its own legal entity, responsible for its own debts, its own obligations, and its own lawsuits. One bankrupt subsidiary doesn't automatically trigger the bankruptcy of its sister companies or its parent company. But, and this is $1 million but, this protection isn't automatic. That corporate veil, that wall between your companies, can be broken. A court can decide to pierce the corporate veil, ignoring the separation and allowing creditors to go after the parent company or even you personally. This is the nightmare scenario for holding company owners, and it almost always happens for a few predictable and avoidable reasons. The number one reason a veil gets pierced is the commingling of funds. This is when you treat your separate companies like your personal piggy bank. You use money from the gym's bank account to pay a bill for the real estate project. You pay for your family vacation directly from a subsidiary's account. You shuttle money back and forth between companies without proper documentation, like formal loans or dividend declarations. When you do this, you are effectively telling a judge, "Your Honor, I don't treat these as separate companies, so why should you?" If you don't respect the separation, the court won't either. Each subsidiary needs its own bank account, its own credit card, its own bookkeeping, period. The second major reason is a failure to observe corporate formalities. Corporations and LLCs are required to act like, well, corporations and LLCs. This means holding annual meetings, even if it's just you in a room. It means keeping minutes of those meetings. It means signing resolutions for major decisions. It means ensuring contracts are signed by the correct entity. If Apex Development is buying land, the contract better say Apex Development LLC, not Alex Holdings or just Alex. This paper trail seems tedious, but it's the legal armor that proves your companies are distinct, legitimate entities and not just a shell game or your alter ego, which is the legal term for it. Another critical factor is undercapitalization. You can't set up a high-risk subsidiary, fund it with a laughable $100, and expect that to protect you from a multi-million-dollar lawsuit. A court will see that as a deliberate attempt to defraud creditors. Each subsidiary must be adequately capitalized for the business it's intended to conduct. It needs enough resources to operate as a legitimate standalone business. Think of it this way: the holding company structure gives you a fleet of legal battleships. Each one is a fortress, but you are the admiral of this fleet. If you run them irresponsibly, if you don't maintain them, if you use one ship's supplies to fuel another without logging it, you can't be surprised when the whole system fails you in a crisis. The power of the liability fortress is directly proportional to the discipline with which you maintain it. This defensive posture is what separates amateur empire builders from professional ones. Amateurs focus only on offense, making money. Professionals understand that true wealth is built and preserved by playing world-class defense at the same time. You can have the most profitable business in the world, but if it's not properly insulated from the risks you take elsewhere, a single bad bet can sink your entire ship. So you've built your fortress. Each business is in its own tower, protected by a thick corporate veil. You're observing the formalities, you're keeping the finances separate, and your core assets are safe from the inevitable storms of the business world. You've mastered defense. But what about offense? How do you use this structure to grow? How do you get the profits from your successful gym business out of its tower, up into the central keep of the holding company, so you can then deploy that capital to build a new tower, a new venture, without creating a tax nightmare? How does the money actually flow? That is the art of capital allocation. And it's where the holding company transforms from a defensive shield into an offensive weapon for building generational wealth. Think of the holding company not as a static legal box, but as a dynamic financial heart, pumping capital throughout a corporate body. The operating companies are the muscles, they do the heavy lifting, they generate the revenue, they create the power. But the holding company is the heart and the brain, deciding where to send that power for maximum growth and strength. This process, capital allocation, is the single most important job of the holding company's management. It separates the good from the legendary. So let's follow the money. It all starts with the upstream flow. Your successful operating company, let's call it OpCo A, has just had a fantastic year. It's sitting on a pile of cash, profits earned after paying all its expenses and its own corporate taxes. Now what? If you, as an individual, owned OpCo A directly, you'd likely take a dividend. That dividend hits your personal bank account and boom, you're paying personal income tax on it, at rates up to 37% plus state taxes. A huge chunk of that profit is immediately vaporized before you can even think about reinvesting it. But with a holding company structure, the story is completely different. OpCo A declares a dividend, but instead of paying it to you, it pays it upstream to its parent, the holding company, or holdco. This is where the magic happens, thanks to a beautiful piece of the U.S. tax code called the Dividends Received Deduction, or DRD. This is a concept that, once you understand it, will change how you see corporate structures forever. In simple terms, the DRD allows a corporation to exclude a large percentage of the dividends it receives from another corporation from its taxable income. If your holdco owns between 20 and 80% of OpCo A, it can generally deduct 50% of the dividends received. If it owns 80% or more, which is common in these private structures, it can deduct 100%. 100%. Let that sink in. OpCo A, having already paid its corporate tax, can send its profits up to the holdco, and the holdco pays zero additional tax on that income. The cash has moved from one corporate pocket to another, completely sheltered from a second layer of tax. This is the financial equivalent of building a protected superhighway for your capital, bypassing all the tax friction and value destruction that individuals face. The money is now sitting in the holding company's bank account, a centralized pool of capital, ready to be deployed. This is the foundation of tax-deferred compounding on a corporate scale. You're not losing 30 or 40% of your growth capital every single time you move it. Now we have the downstream flow. That pool of cash in the holdco is not meant to sit idle. The job of the capital allocator, the CEO or the board of the holdco, is to act like a world-class investor. They survey their entire empire of operating companies. Maybe OpCo A is a mature business, a cash cow that doesn't need much more capital to grow. But you've just started OpCo B, a high-growth tech venture that's burning cash but has enormous potential. Without a holding company, OpCo B would have to go to a bank for a loan, giving up control and facing restrictive terms. Or it would have to find outside venture capitalists giving up precious equity. With the holding company, the solution is elegant. The holdco makes a capital contribution, or a capital injection directly into OpCo B. It's essentially buying more shares of its own subsidiary. This cash infusion allows OpCo B to hire engineers, launch its marketing campaign, and scale its operations, all funded internally. The wealth generated by the stable, mature business is being used to fuel the growth of the new, promising one, all under the same roof and without paying a dime in tax to move the money from point A to point B. But what about sideways movement? What if OpCo A is doing okay, but OpCo C, another one of your businesses, just landed a massive purchase order and needs short-term cash for inventory? It doesn't need a permanent equity investment. It just needs a bridge loan for a few months. Again, going to a bank is slow and expensive. The holdco can act as the internal bank. It can take that dividend cash from OpCo A and issue an intercompany loan to OpCo C. This is a formal loan, with a promissory note and a reasonable, market-based interest rate. This is critical. The IRS insists these transactions be at arm's length, meaning you have to treat it like a real loan, not just a casual cash transfer. OpCo C gets the cash it needs instantly, at a better rate than a bank would offer. And the interest it pays on the loan? It goes right back to the holdco, keeping the wealth inside the family. Once OpCo C fulfills its order and gets paid, it repays the loan to the holdco, and the capital is returned to the central pool, ready for its next mission. This system, the upstream flow of dividends, the downstream flow of equity investments, and the sideways flow of loans, creates what financiers call an internal capital market. You have created your own private, hyper-efficient version of Wall Street, exclusively for your businesses. You can move money from cash-rich entities to cash-starved ones with incredible speed and tax efficiency. You are no longer at the mercy of banks and outside investors. You decide which ventures get funded, which get expanded, and which get starved of capital. The undisputed master of this game is Warren Buffett's Berkshire Hathaway. It is the ultimate example of a holding company as a capital allocation machine. Think about it. Berkshire's insurance companies, like Geico, generate massive amounts of cash called float, premiums that are collected up front but not paid out in claims until later. This float, along with the profits from wholly owned businesses like See's Candies and BNSF Railway, flows upstream to the holding company in Omaha. Then Warren Buffett and Charlie Munger, acting as the chief capital allocators, decide what to do with that colossal pile of money. Do they reinvest it in BNSF to buy new locomotives? Do they use it to buy billions of dollars of Apple stock? Do they acquire an entirely new company like they did with Duracell? They are playing the game on the grandest scale imaginable, using the profits from one set of businesses to fund investments in a completely different set, all under the tax-efficient umbrella of the holding company. They are not taking huge personal dividends and paying massive tax bills. They are letting the capital compound within the corporate structure for decades, creating one of the greatest wealth creation engines in history. This is the offensive power that was mentioned before. The liability shield is defense. The capital allocation is pure offense. It's the ability to make your own strategic decisions, to fund your own growth, to be your own bank. It transforms a scattered collection of businesses into a coordinated, powerful economic force, where the whole truly becomes monumentally greater than the sum of its parts. But this power comes with immense responsibility and complexity. Wielding this tool effectively is one thing, but avoiding the catastrophic mistakes that can turn this dream into a nightmare is another challenge entirely. What are the hidden traps? And the most common trap is the seduction of complexity itself. Starts innocently. You read about asset protection, you hear about compartmentalizing risk, and you think, more is better. You set up an LLC for your rental property. Good. Then another for your e-commerce store. Makes sense. Then you form an LLC to hold your stock portfolio, and another one for a consulting side hustle you might start one day. Then you create the holding company to own them all. But then you think, what if my holding company gets sued? I need a holding company for my holding company. Before you know it, you've built a labyrinth. A beautiful, intricate, legally sound labyrinth on paper. But you've forgotten one crucial thing. You have to live in it. Suddenly, you're not a business owner anymore. You're an administrator of a bureaucratic empire of one. You're drowning in paperwork. Each one of those LLCs needs its own bank account. Each one needs separate bookkeeping. Each one needs to file an annual report with the state, each with its own fee. You're paying for 5, 6, 7 registered agents. Your accounting bill at the end of the year looks like a phone number because your CPA has to file a separate tax return for each entity and then consolidate it all. The cost in both time and money.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Begins to devour the very profit you were trying to protect. You've built a fortress so secure that you can't get any work done. The tool has become the master. You're so busy managing the structure that you forget to manage the businesses that are supposed to be making money. This leads directly to the second, and perhaps most catastrophic mistake. Believing the structure alone makes you invincible. People hear the words corporate veil, and they think it's a magical force field. It's not. It's a legal courtesy, a privilege granted to you on the condition that you respect the separation between yourself and your companies. And the fastest way to lose that privilege is to treat your companies like a personal piggy bank. This is called piercing the corporate veil, and it happens every single day. It looks like this. You're at the grocery store and your personal debit card gets declined. You think, no problem, and you pull out the business card for your rental property LLC and pay for your milk and eggs. Or you need to pay for your kids' college tuition, so you just wire the money directly from your holding company's account. You think, it's all my money anyway, right? Wrong. In the eyes of the law, you have just committed the cardinal sin, commingling funds. You have demonstrated with your own actions that you do not see a difference between your money and the company's money. So why should a judge? Imagine a tenant slips and falls at your rental property and decides to sue. Their lawyer starts digging. They subpoena your bank records, and they find it: the grocery bill, the tuition payment, the time you paid your personal car insurance from the business account. They will stand up in court and argue successfully that your LLC is a sham. It's not a real separate entity. It's just your alter ego. The judge agrees. And just like that, the corporate veil evaporates. The lawsuit doesn't just hit the rental LLC anymore. Now they can go after the holding company that owns it. And if you've been commingling funds there too, they can come after everything: your other businesses, your stock portfolio, your personal home, your savings. The entire structure you built for protection becomes a conduit for its own destruction. All because you couldn't be bothered to write yourself a proper paycheck and use the right debit card at the checkout line. It's not just about commingling funds. It's about corporate formalities. Did you hold an annual meeting for each LLC, even if it was just you in a room with a laptop? Did you write down minutes for that meeting? When your holding company loaned money to a subsidiary to buy a new piece of equipment, did you draw up a formal loan agreement with an interest rate and a repayment schedule? Or did you just move the money and make a note on a napkin? If you don't treat your companies like real separate businesses, the law has no obligation to either. The third trap is the tax quicksand. The holding company structure opens up a world of tax strategies, but it also opens up a world of new ways to make devastating errors. A common mistake is getting the flow of money wrong. You can't just vacuum money up from your profitable subsidiaries into the holding company tax-free whenever you feel like it. That movement of cash has a name. It's often a dividend. And if your companies are structured as C corporations, that dividend gets taxed at the subsidiary level when it's earned, and potentially taxed again when it's received by the holding company, and then taxed a third time when you pay it out to yourself. People try to get clever, calling it a management fee or a loan. But if you can't prove that the holding company provided real services worth that fee, or if that loan never gets paid back, the IRS will happily reclassify it for you in the most painful way possible. Then there's the multi-state nightmare. Let's say your holding company is based in Wyoming for its privacy laws, but you own an operating LLC in California, another in New York, and a rental property in Florida. You've just created what's called a tax nexus in all of those states. Your Wyoming holding company may now have an obligation to file and pay taxes in California, New York, and Florida, because it owns and derives income from assets in those locations. Each state has its own tax code, its own filing deadlines, its own set of rules designed to confuse and extract money. Suddenly, your simple, elegant structure requires a team of multi-state tax experts just to stay compliant. You thought you were simplifying your life, but you've just invited the tax authorities from 3 of the most complex states in the union into your living room. Finally, there is the silent killer. The exit strategy blind spot. You spend years building this magnificent portfolio. You have a holding company that owns a thriving software business, a portfolio of cash-flowing rental properties, and a stake in a local restaurant. You've done it. You've built an empire. Then, one day you decide you want to sell the software business. A buyer comes along, they love the product, and they're ready to write a 7-figure check. Their lawyers start due diligence, and what they find gives them a panic attack. They see a tangled web of intercompany loans. They see management fees being paid to the holding company with unclear justification. They see commingled expenses from 3 years ago. They can't tell where the software company ends and the holding company begins. They aren't just buying a business. They're buying a decade of your messy accounting. The deal gets more complicated, the legal fees mount, and the buyer's confidence plummets. They either walk away, or they drastically lower their offer to account for the risk and the headache. Your failure to keep things clean has just cost you hundreds of thousands of dollars. These aren't hypothetical scenarios. These are the eulogies for failed holding companies, whispered in the offices of lawyers and accountants across the country. The power of this structure is matched only by its potential for self-destruction. The lines you have to walk are fine, the rules are unforgiving, and the consequences are absolute. So with a landscape this littered with traps, how does anyone succeed? How do the masters of the game, from the Berkshire Hathaways of the world down to the savvy Main Street entrepreneurs, navigate this minefield? They don't just avoid the mistakes, they follow a different set of rules entirely. They have a playbook for building empires that last. What is that playbook? What are the strategic secrets and the non-negotiable principles they use to turn a holding company from a potential liability into an unstoppable engine for generational wealth? It's a playbook built on a few core, almost deceptively simple principles. But like a grandmaster in chess, the genius isn't in knowing the rules. It's in their flawless, relentless execution over decades. The first and most critical page of this playbook is called the North Star. Every legendary holding company has a crystal-clear, non-negotiable investment thesis. This isn't just a vague mission statement about creating shareholder value. It's a deeply ingrained philosophy that dictates every single acquisition. For Warren Buffett's Berkshire Hathaway, the North Star is the durable competitive moat. They don't just buy companies, they buy fortresses. Businesses so dominant, so protected by brand, scale, or regulation that they can weather any economic storm and fend off any competitor. Think about it. Coca-Cola's brand, BNSF Railway's irreplaceable tracks, Geico's cost advantage. They aren't interested in the hot new tech startup that might be obsolete in 5 years. They are buying institutions, businesses that they believe will be just as relevant, just as profitable 50 years from now. This North Star acts as a filter. It eliminates 99% of potential deals immediately, saving them from the temptation of chasing short-term trends. It forces discipline. The question isn't, can we make money on this? The question is, does this fit our definition of a truly great business that we want to own forever? Without this unwavering North Star, a holding company is just a random collection of assets, a ship without a rudder. With it, every acquisition becomes a deliberate strategic step toward building an invincible armada. The second principle is mastering the art of capital allocation. This is the true job of the holding company CEO. They are not operators, they are investors. Their primary role is to act as the ultimate financial brain, deciding where every dollar of profit generated by the entire empire should go next. Imagine the holding company as a central bank for its own private economy. Its subsidiaries are the individual states. Some states, like a mature manufacturing company, are cash cows. They produce huge, stable profits but don't have many opportunities for high-growth reinvestment. Other states, like a fast-growing tech subsidiary, are cash-hungry. They have incredible opportunities but need fuel to grow. In a normal corporate structure, that mature company might just sit on its cash or pay it out as a dividend to shareholders, who then pay taxes on it. But inside the holding company, something magical happens. The CEO can take the excess cash from the cash cow state and, with incredible tax efficiency, redeploy it to the high-growth state. It's a closed-loop system for compounding wealth. This is what Charlie Munger meant when he said Berkshire is a system for moving money from businesses that have too much of it to businesses that can use it better. They are playing a different game. While other CEOs are focused on running a single business, the holding company manager is playing a portfolio-level game of chess, moving capital across the board to the square where it can generate the highest possible return for the entire system. It is the single most important lever for creating long-term value. This leads directly to the third, and perhaps most misunderstood, principle, a culture of radical decentralization. This seems like a paradox. How can a central brain allocate capital so effectively if it's not involved in the day-to-day operations? The answer is a philosophy that can be summed up as, hands off the operations, hands on the capital. The great holding companies buy great businesses that are already run by great managers, and then they get out of the way. They don't send in a team of consultants from headquarters to tell the CEO of See's Candies how to make chocolate. They trust that the CEO on the ground knows their business, their customers, and their market better than anyone in an office in Omaha ever could. This autonomy is incredibly empowering. It attracts and retains the best entrepreneurial talent, people who want to run their business, not be micromanaged by a corporate parent. But this freedom comes with a simple, non-negotiable pact. The subsidiary CEO's job is to run their operation as efficiently and profitably as possible. Then, they send the excess profits upstream to the holding company. The holding company CEO's job is to then take that capital and decide if it should be reinvested back into that same subsidiary, or if it would be more productive being sent to a sister company, or used to acquire an entirely new business. It's a beautiful symbiosis of centralized discipline and decentralized freedom. It allows each part of the machine to specialize in what it does best, creating a system that is both agile at the operational level and incredibly strategic at the capital level. The fourth pillar of the playbook is the structural advantage of permanent capital. This is the secret weapon that separates holding companies from almost every other investment vehicle, like private equity or hedge funds. A private equity fund has a fixed lifespan, typically 7 to 10 years. They are forced to buy a company, fix it, and then sell it to return capital to their investors. They are operating on a clock. A holding company has no clock. When Berkshire Hathaway buys a company, their preferred holding period is forever. This is a profound difference. It allows them to make decisions with a time horizon that is simply impossible for their competitors. They don't have to worry about dressing up a company for a quick sale. They aren't concerned with what Wall Street thinks about their next quarterly earnings report. They can invest in projects that might not pay off for a decade. They can endure a multi-year downturn in a specific industry, knowing they have the financial strength from their other subsidiaries to wait for the recovery. This patient, permanent capital base transforms their entire approach. It allows them to be the buyer of choice for family-owned businesses whose founders want to see their legacy preserved, not chopped up and sold for parts. It allows them to be greedy when others are fearful, buying assets at bargain prices during market panics because they know they never have to sell. Permanent capital isn't just a financial term. It's a strategic philosophy that enables true long-term thinking, the very bedrock of building generational wealth. When you combine these principles, a clear North Star, masterful capital allocation, decentralized autonomy, and permanent capital, you create something extraordinary. You create a flywheel. It's a self-reinforcing engine that, once it starts spinning, gains momentum with every turn. Here's how it works. A collection of high-quality, cash-generating businesses sends its profits up to the holding company. This cash flow is shielded from significant tax drag as it moves within the corporate structure. The holding company's management, guided by its North Star, then allocates that capital towards its highest and best use, either reinvesting in an existing business or, more powerfully, acquiring another great business. This new acquisition then adds its own stream of cash flow to the central pool. The flywheel has just gotten heavier. It spins a little faster. Now there's even more cash to allocate. This allows for even larger acquisitions, which in turn generate even more cash. All the while, the permanent capital structure allows the management to ignore short-term noise and focus solely on increasing the flywheel's long-term momentum. It becomes an unstoppable compounding machine. Each element reinforces the others. The great businesses attract great managers who thrive under autonomy. Their well-managed operations produce the cash that fuels the capital allocation engine. The permanent capital base allows the allocators to be patient and opportunistic, buying more great businesses at great prices. It is a perfect virtuous cycle, a system designed for the express purpose of compounding capital at a high rate over a very, very long time. This is the ultimate playbook. It's not a get-rich-quick scheme. It's a get-rich-forever system. It's how you turn a simple corporate structure into an empire.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.